Guys, welcome back. Well, today we saw what was brewing last night. If you remember on the video, we were looking at the pre-market. We saw all of the stocks start to pull back overall. I was expecting to see some profit taking today, but did we expect to see the sheer velocity of profit taking that we saw today? Probably not. I think it caught most of us investors by surprise. The sheer velocity overall was a pretty startling. In fact, it wasn't just the memory sector. There was profit taking and pullback that happened across the broader tech sector. In fact, if you looked at the NASDAQ today, it shot completely down. It drove further down than any other index that we saw. And it wasn't just the US memory players. It was started by just kind of this broader contagion, we'll say, that happened out of Korea overnight and spilled over into the US market. So this wasn't a standard intraday breather. It was a violent mechanical markdown across the entire domestic memory and hardware complex. Let's jump into the tape. Let me just show you exactly what we saw today. Typically, when I look at these Yahoo Finance, we're looking at the top gainers. But today we're looking at the top losers. And you can see across the board, we have the Fab Four, the memory titans that are populating towards the top of that list, driven by the top two, SanDisk and Micron. You can see SanDisk today, it was down over $300, down over 13% on the day. Micron, right there with it, over 13%, down over $160. You can see where those stocks closed. For me, a little bit of silver lining, I would say, is that it held the $1,000 higher than the $1,000 level. And you can see SanDisk is right there, right below the $2,000 level as well. So a little bit of silver lining to me as I look across the day, but there's no question. Look at all the names on the board. Everyone name that we track in this AI infrastructure build out is here. You can see we've got the energy providers. We've got the picks and the shovels. We've got the optical players and Lumentum. We see Western Digital and Seagate just to round out the Fab Four. Look at Western Digital down by 8.5%. Seagate down by 5%. If I go down lower, just to show you, we see Applied Materials. We see Coherent, Astera Labs, ARM Holdings. I can go on and on. Vertiv. This was a day where we saw broader selling happen across the entire sector. And just to show you, when you look at the NASDAQ 100, look at the impact here. Look at that left side, how bright red it is. Everything from Broadcom, Micron, AMD, Intel, ARM. You see Marvell there. You see ASML, Applied Materials, Lam. Even here, the other memory providers that I covered. So it was a broad contagion sell-off across the board. There was no question about it in my mind. So that was the setup that we saw for today. The question is, why did it happen? Like, what were the driving factors overall? Because right now we're seeing mainstream retail forums. They're just absolutely panicking, assuming that the AI infrastructure cycle has completely tapped out. But in my opinion, guys, there's three big things, in my opinion, that drove today's performance. One, we saw a high leverage glitch, a regulatory glitch in South Korea that triggered a massive global sell-off across the board. There was a misconception or a rumor around HBM4, the production ramping down by SK Hynix. I want to cover that as well in today's video. And I also want to discuss what exactly this technical flush means for Micron's high-stakes earnings report that drops tomorrow at the end of the market, at the end of the day, excuse me. That print, probably the biggest print we can see all year right now. Will it fundamentally shift the momentum that we see in the market right now? Could it potentially save the AI trade overall? I saw a lot of news articles today just stating that in general, just talking about how big these earnings print will be tomorrow for Micron and what it means to the total market overall. So we're going to strip away all the noise. I'm going to dive into those three factors that I think influence the market today overall. And we're going to get into explain what that exactly means to Micron, what Micron needs to show tomorrow, and how this stock looks moving forward. So let's get started. But if you haven't done it already, make sure you hit like, make sure you hit subscribe to the channel. Let's see if we can get this channel up over 30,000 subscribers tonight. We're getting close. We're probably about 700-800 subscribers away. So this would have to be a massive video to get it up over 30. I think we can do it. So if you haven't subscribed yet and you like this content, do me a favor, hit the subscribe button now. Let's get started in the video, guys. To understand why our domestic memory plays took a double-digit hit today, like we saw with Micron and SanDisk, you have to trace the mechanics straight back to what occurred overnight in Seoul, because there was two big stories, two big factors that came out of the South Korean market that had a significant influence on the memory trade here in the US. So let me pull up the first one and we walk through it together. But this first one, as I pull up, I have to say that this catalyst It had absolutely nothing to, it has nothing to do with the fundamental enterprise AI demand or a slowdown in chip orders. Instead, what we're seeing is the Financial Supervisory Service, or the FSS. The governor of that held a regular briefing and expressed severe public regret over approving a batch of high leverage single stock ETFs that are tracking Samsung and SK Hynix. These single stock leverage funds have ballooned from a combined 3 billion at launch to over 14 trillion won just in a matter of weeks later. That 14 trillion won represents about just over 9 billion in US dollars. So the governor revealed that 92% of the holders of these funds are retail investors. And so he sent a warning out that this trade was dangerously overheated, and it amplified market volatility across the board. So when these comments hit the wires, what we saw was panic, essentially. Foreign and domestic institutional desks aggressively offloaded the underlying stock positions to manage risk. And because SK Hynix and Samsung now represent over 50% of the index there, we saw that index drop down today. Samsung and SK Hynix were also down by double digits overnight. The Korean index was down, I think, by 12%. So it essentially just crushed that index because of the weight those two companies have in the index overall. And remember, they are direct global memory peers to the U.S. hardware names. So this local ETF deleveraging that we saw in Korea, it sent immediate programmatic shockwaves across the Pacific into the U.S. pre-market trading. That's why we saw our names drop so aggressively in the pre-market and gap down like they did. And I'm going to show you that gap down in a moment that we saw with Micron and SanDisk. So as that automated regional selling crossed over into the Pacific, the financial media also weaponized a highly specific, deceptively bearish headline regarding high bandwidth memory. Reports surfaced claiming that SK Hynix was altering its next generation HBM4 production timeline, that they were ramping down essentially. And fearful investors assumed that this meant that cloud hyperscalers were canceling orders. But let's actually do a fact check. Let me pull up the article that came from TrendForce and show you the exact verbiage that they said and what caused this deceptive headline that drove the performance down even further. But let's dive in to see what actually the headline said. But you can see here that from TrendForce, it says memory giants split on HBM4. Samsung's HBM4 sales reportedly top 1 billion. SK Hynix slows ramp. That slows ramp is the deceptive headline that the bears took to drive these stocks further down. But let's go in and actually see the mechanics behind why. I think the fact that Samsung is already crossed the billion, the fact that that didn't hit a headline was a big piece of the story overall as well, because you could see that HBM4 has surpassed 1 billion in revenue, making it the first product in industry to reach that level just 4 months after entering mass production in February. But this is the piece here. SK Hynix slows HBM4 ramp. But it is a choice by the company, not because of demand. You can see it's more of a strategy around margin optimization. So HBM already accounting for 40% of the revenue. SK Hynix is now prioritizing margin optimization over aggressive capacity race. The memory maker is slowing the pace of HBM4 production ramp up as it shifts gears to focus more on the tightening commodity DRAM market, where pricing conditions are seen as more favorable for near-term profitability. Instead of pushing further into the next HBM expansion, the company is increasingly prioritizing the DRAM segment, where DRAM operating margins are projected by analysts to approach a theoretical peak of 90% within the year. So SK Hynix has already been benefiting from stronger DRAM pricing momentum. The company reported a mid 60% increase in average selling prices for DRAM in the first quarter. We know the fact that it has a 3-year DDR5 supply agreement with Microsoft. So it's viewed that this is reinforcing their long-term earnings visibility in the commodity DRAM segment. TrendForce notes that SK Hynix HBM4 mass production timeline has been pushed back, meaning volume now expects to ramp in third quarter of this year. As a result, full year HBM4 shipment outlook has been revised downward from 4.5 billion gigabits to 4 billion gigabits overall. And you can just see the table here. I won't go through all of it, but essentially Samsung is in aggressive expansion. SK Hynix is in margin optimization as they focus on DRAM, and Micron is a follower, demand aligned essentially across the board is what it calls out. So guys, this was seen as a bearish article overall, that demand was slowing down. But in reality, SK Hynix is just doing a margin optimization strategy, because we've seen DRAM just get squeezed, and we've seen that these big three have focused their production on HBM. It has starved the market of DRAM. We've seen the prices jump up across the board. The average selling prices have surged for the DRAM. So SK Hynix is shifting that way just to they can affect their balance sheets and drive their operating margins even further. So they are simply optimizing their product mix. They're shifting miner capacity back to capture those massive near-term commodity DRAM premiums while tweaking slightly the HBM4 ramp. Meanwhile, demand is so intense that Samsung is running full steam ahead, as we saw. They passed $1 trillion in 4 months since they launched. So that has never been done in history, as the article said. I think that should have been in the headline that came out. Suppliers are right now, they're playing chess to maximize margins across the entire memory stack. Demand is not fading at all, as the bears tried to point out with this news or this deceptive headline that we're seeing HBM4 ramp slow down. In fact, we're seeing it the reverse. It's never been more accelerated than we have before, with companies, like I said, with Samsung hitting levels that we haven't seen before. But we are seeing these companies tweak so they can maximize their margins and take advantage of the environments in which they play in right now. It's exactly what SK Hynix is doing with DRAM, pushing back the ramp just about another quarter or so, third quarter of this year. When the regular session algorithmic selling hit New York this morning at 9:30 a.m. at that opening bell, it triggered an incredibly aggressive sector-wide volume flush. Let's take a look at the gap down that we saw with Micron and SanDisk. As I mentioned, I was going to show you that in the candle reports. Look where Micron closed on a nice upswing. Remember that strong volume that we had to finish the day yesterday? Look at the gap down right from the get-go. This was the algorithmic flush that came over from South Korea across the Pacific into the U.S. markets. We saw it with Micron. We also saw it with SanDisk. The same thing. SanDisk had a little weakness finishing the day yesterday, a little bit reverse of what we saw with Micron, but look at the gap down. Look at the flush immediately we saw at the opening bell, and just tried weakly to have a bit of conviction, flush back down, and had a bit of a sideways digestion throughout the day across the board. But guys, this was entirely a market structure and positioning event driven by systemic leverage rather than a breakdown in the underlying corporate health. You have to remember, we have products out there like SOXL, an ETF that is a popular triple leverage product in the marketplace. That fell sharply in the early trading today as well, because these leverage products use derivatives that must reset daily. They are mathematically forced to rebalance their positions dynamically to maintain their leverage targets. There was a very good article that I saw on investing.com that I want to cover with you. You can see the headline. It says, chip sell-off is not just about AI. It's a bigger problem under the hood. And I want to focus in on a couple things here. It's like when rocket fuel becomes the problem. This talks about SOXL, the ETF here, and how these products must reset every single day. The author goes on to say, when an index goes up like 2%, SOXL aims to go 6% because these products reset every day. They have to rebalance their positions constantly to stay at the right ratio. And when the market falls, they have to sell into weakness to maintain that leverage weight. If we scroll down further, I want to bring up this article right here. This part of it says the tail is wagging the dog. And I'm going to read this to you. It says the businesses, at least of the last earnings cycle, these memory companies are still growing fast. But when enough leverage builds up in the sector, ETF rebalancing can temporarily dominate price action and make the tape look far worse than the fundamentals. Leverage can overpower the underlying business reality in the short run without permanently changing the investment case. That is the key distinction here. So if Tuesday's move is primarily forced deleveraging rather than a real shift in AI demand, the bounce, when it comes, could be faster and sharper than the size of the drop implies. Forced selling creates overshoots in both directions. That's a key line that we have to remember. And I love this kind of graphic they have here, how chip dip became a volatility event. It goes from AI enthusiasm to leverage ETF crowding, forced selling, Korean spillover, and now we have Micron's earnings. And it says Micron is the next real test. In practice, this means Micron is walking into earnings carrying two jobs at once. It needs to report a strong quarter just to meet expectations, but it also needs to say something about forward demand that reassures investors that today's it reassures investors after what we saw today in the market and the shakeup overall. If results disappoint or if guidance comes in softer than expected, the leverage products are going to unwind again. They're going to sell more into weakness, and we're going to continue to see this cascade dropping that we saw today, this kind of leverage drop overall and sell off. It will continue to accelerate. So they'll have a fresh reason to keep selling, and that loop starts again, as the author goes on to mention. So what exactly do we expect or do we need to see from Micron tomorrow? Job number one from them for their earnings is going to be to show strong, incredibly strong revenue overall, that it meets the existing expectations or blows those expectations out of the water. We know that the consensus revenue right now expectations for Micron is just under $35 billion. It represents a massive year-over-year explosion. So they have to pass that number, and they also have to show that their operating margins are around 81%. That's exactly what the street is looking to see. So Micron has to deliver on those two numbers overall. Job two, and most importantly, or even more, equally or maybe more importantly, is they have to say something strong about forward demand, something that reassures investors, like the author said. Management needs to explicitly confirm that their production capacity remains completely sold out and that forward visibility is fully intact. If the company successfully delivers on both of those fronts, it could act as a critical stabilizer for the entire semiconductor sector, not just for the Micron stock. But beyond those immediate numbers, what are the real underlying metrics that we as investors need to listen for further in this report overall that could also help influence the sector one way or the other? So we have to focus on two fundamental indicators, or listen for two fundamental indicators tomorrow overall. The first one is kind of the DRAM supply gap and the customer allocation. Right now, Goldman Sachs has pegged the global DRAM supply-demand gap at about 4.9%. They described it as the most severe hardware shortage that this industry has seen in 15 years. In fact, enterprise supply is so tight that Micron is only able to fulfill 50% to 2/3 of its key customer demand in the medium term. If tomorrow's commentary from the CEO shows that the supply-demand gap is widening further, it confirms the massive structural pricing power regardless of the short-term stock pullbacks. And the second thing we have to listen for is all around strategic customer agreements. Look for updates on Micron's multi-year strategic customer agreements. In past cycles, memory was a volatile commodity where buyers could cancel orders at the first sign of downturn. This year, Micron has been signing 5-year partially fixed price volume commitments that lock in the hyperscalers and enterprise clients. If management announces a deeper expansion of these strategic customer agreements, it effectively proves that the historic volatile boom-bust cycle of the memory has been broken, structurally de-risking the business overall. But there was another report or rumor that I saw floating around today. I wonder if you guys saw it as well. It was a rumor or fears that hyperscaler CapEx spending was going to slow down in the second half of 2027, that we were going to have a supply glut in the second half of next year. And that was worrying investors and analysts overall as well. So I came across this article today that I think completely puts it into the right perspective. So let me pull that up and we'll walk through it together, because you can see in the article, it says memory to account for nearly 50% of hyperscaler CapEx by 2027 per SemiAnalysis and CLSA. So here's the one thing I want to call out, that memory share of hyperscaler CapEx is projected to climb from roughly 8% in 23-24 to 30% in 26. And then further projections is estimating that memory could account for 48% of hyperscaler CapEx by 2027, up from 35 this year. Hyperscaler CapEx is now forecasted right now it exceeds $800 billion for this year. Consensus estimates approaching or surpassing $1 trillion in 2027. So that goes out the window right there, with hyperscalers slowing down in the second half of next year. Firms like Goldman Sachs, Morgan Stanley, and Moody's have all revised their projections upward through mid-2026. If memory genuinely captures 48% of $1 trillion budget, that's nearly $500 billion flowing into DRAM, HBM, and other technologies in a single year. For context, the entire global semiconductor industry generated around $527 billion revenue in 2023. Just think about that. The entire semiconductor industry generated that. We're talking about 500 billion in DRAM, HBM, and related technologies in a single year. So when memory was 8% of CapEx, price swings were a rounding error. When it's approaching half the budget, memory pricing becomes the first order of concern for Microsoft, Amazon, Google, and Meta. Their return on invested capital calculations change dramatically if DRAM prices stay elevated or climb further. So I hope that puts kind of the rumor to rest around hyperscalers slowing down in the second half of next year. I think we're seeing that pricing power will maintain with the manufacturers through next year. But let's not kid anything about this when I say that if Micron disappoints tomorrow in the after hours with their print, or if management gives a soft forward guidance, the leverage products that we saw today, those ETFs that I went through, they're going to actively unwind, and we'll have a fresh fundamental reason to keep selling. We will see a dramatic sell-off if that happens overall. The reflex loop will start all over again, dragging the rest of the sector down with it as well. So tomorrow afternoon, the great news is that all this noise that we see around us right now in the environment, it fades away because we finally get the hard fundamental truth when Micron drops their print on the street. Micron just doesn't own destiny tomorrow. Its guidance will set the definitive trajectory for the entire global memory complex. It'll dictate where SanDisk, Western Digital, Seagate, and the Korean Titans move next. So as the author stated in that investment.com article, I said that forced institutional deleveraging, it historically creates severe overshoots to the downside, which frequently turns into an exceptional window of opportunity for investors who actually understand the plumbing of this trade. So as we head into tomorrow, make sure you continue to position your size defensively. Block out all the emotional retail panic and the noise that'll be on the message boards, that'll be in the headlines. And let's watch the tape together. Let's see what Micron drops on the street. I'm going to put my video out immediately after that happens, give you my reflection, my thoughts on it overall, but I feel it's going to be a good one tomorrow. Let me know below if you feel the same way. Guys, hope you enjoyed the video. I'll see you in the next one.